Hi guys, I welcome you all to the second video on the SEBI current affairs pertaining to the month of July 2018. So in the previous video we started our discussion on the current affairs pertaining to Securities and Exchange Board of India, that is SEBI, for the month of July 2018. And in this video we are going to learn more current affairs and many more concepts pertaining to SEBI through this particular coverage. So let's start with the first one, which is stockbrokers can't accept cash from clients. So there is this limitation which is being imposed on stockbrokers. So these are the persons who are facilitating the trading in the securities in the stock market, and now there is this restriction being imposed on these persons that they cannot accept cash from clients. So how are they going to accept money from the clients in order to trade in stocks? Now they can only get money from clients in the form of a electronic transfer or through use of bank account, like through use of checks or even through mobile banking. So now they have to employ the methods of digital banking or traditional banking facilities in order to transmit the money, and cash cannot be used now for this particular purpose. So SEBI has initiated this particular move because SEBI plans to encourage paperless and cashless trading in the stock market in the country. SEBI has highlighted the fact that the government had promoted various means for transfer of funds through digital mode, and SEBI also feels that it is obliged to work in this direction and it has to work towards a cashless economy. Now if we try to understand the role of stockbrokers in securities market, so you can see there is this person here. This is the stockbroker. Now this is the person who is acting as an intermediary between the persons who are having the stocks or dealers and the persons who have the money to buy these stocks. So earlier what happened, these persons, they used to give cash to this stockbroker and it used to buy shares using this particular money, and then it used to give these particular shares to the buyers back. So this was happening earlier, but now what is being proposed? It is being proposed that now the money is to be transferred to broker electronically in order to procure shares from the dealers. And in this process, this particular person, the broker, it usually charged a small fee or a commission. Next one is SEBI mulls UPI based payment for IPOs. So you can see how SEBI is gradually moving towards promoting digital banking for securities market in the country, and now it is talking about UPI based IPOs. Now I believe you must be aware about UPI. UPI is a unified payments interface, and UPI is an instant payment system which has been developed by National Payment Corporation of India, and I believe you must be transmitting money through this particular interface and maybe getting some cashbacks also. So I believe you may be more aware than me also on this particular front, and I should more probably restrict my discussion to SEBI and IPOs. Now SEBI feels that if we move towards UPI based IPOs, so if the investors, if the retail investors specifically, they are moved to this UPI based IPOs, it can cut the time taken between the closing of an IPO and the listing of the security from the current 6 days to just 3 days. So now it takes 6 days between the closing of an IPO and the listing of the security. But if we use this UPI based system, unified payment based interface system, then it can be reduced to just 3 days, and it will also do away with the physical movement of application forms. So it is believed that if we employ this particular technique, the money can be easily transmitted from the investors to the company. So as this money is going to be easily transferred to the company, the time it takes to list the securities, it can be reduced. So this is the main advantage of using this particular technique. Now for the guys who are not aware what is an IPO, now IPO is an initial public offer. So what happens, there is a private company. For example, there is a private company, and this private company, it wants that I should have a presence on stock exchange. Now what it does, it to get the presence on stock exchange, it sells its shares to the public and it becomes a public company in this regard. So why does this private company wants to become a public company? There may be many reasons. It wants to expand. It wants to create more awareness about its products regarding the consumers. It wants to attain credibility. It wants to attain more liquidity, and it wants to attract more top talent towards its company. So for all these purposes, this company may want to go public, or it may come with an initial public offering. Now with an initial public offering, this company is offering the shares of this company to the public at large. So the public will come, it will put in money in the shares of this company, and this company will give them this share. And in future, when this company grows, what will happen? This company will give these shareholders, these owners of the company, huge returns. They're going to get dividends from the company. They're going to earn in the form of price appreciation. So they're going to get huge benefits. And if you analyze here this one more pictorial aspect presented in this particular diagram, you will see that if this was a private company, you can see there is this only one person here. There is this only one single owner which is being represented here. But when it becomes a public company, there are many owners which are here. So it means when there is a private company, there are a very less number of people who are controlling this company. And if it becomes a public company, there are many people who become the owners of that particular company. So IPO is when a private company or a corporation raises investment capital by offering its share to the public for the first time. So this first time means I means initial. So initial public offer means the company is coming up with an issue for the first time. Now growing companies are seeking capital to expand, they can come up with these IPOs, and the private corporations who wants to have a wider reach, who wants to acquire more top talent, who wants to generate awareness about their products, they can come up with these IPOs. Now IPO under UPI system, how this is going to work? Now under the new system, investors are going to fill in all the details for applying to an IPO as per the existing process, but they also have to fill their UPI ID. So they will fill their UPI ID, which is going to be linked to their own bank account, and they will validate the request by logging on to the mobile app that supports UPI payment. So using this particular UPI system, there will be instant transfer of money between the investor and the company. So there is going to be this huge reduction in time as well as savings in cost using this UPI based system. Now UPI based system will only be restricted to retail investors. Why only to retail investors? Because the institutional investors and high net worth individuals, they are those people who are investing money for more than rupees 2 lakh, and at present there is this maximum limit which is being proposed for UPI transfers, that is rupees 2 lakh. So if this amount is going to be capped at rupees 2 lakh, only retail investors, they are going to be using this particular facility, and the persons who put in more than rupees 2 lakh, they fall in this category of institutional investor and high net worth individual. So they will have to just continue to use the existing process for the time being. So the crux of the discussion is that UPI plus IPO is equal to less time. So this is the crux. Now let's move forward. Delisting of companies, promoters to make counter offer. So there is this change being proposed in the case of delisting of companies. So first we must be aware of what is delisting of companies. Delisting is the removal of a listed security from a stock exchange. So if there is a security which is listed on a stock exchange, for example, say there is a share of a company ABC Limited and these are listed on the stock exchange. Now this ABC Limited feels by listing my shares on this stock exchange, I have to comply with a hell lot of regulations. I am dying under this compliance burden. I don't want to get into all these formalities. I want to simply buy the shares which the investors are having of my company. The promoters, they are thinking this particular thing, and they say that after buying those shares they will delist the company. The shares are not going to be traded in the stock exchange. So now SEBI has proposed a new set of measures so that promoters can make counter offers in the case of delisting of company, and SEBI has suggested for a price discovery as per reverse book building method, along with considering counter offer of promoter. So this proposal is being proposed to plug the loopholes which are presently there in the current delisting method of companies. So by now we have understood what is delisting, and we have understood that some change is going to be there in delisting, and these terms, the reverse book building process and considering counter offer of promoter, they are associated with this particular process. Now let us look at this particular term, which is reverse book building. Now reverse book building is a process wherein the shareholders, they are asked to bid for the price at which they are willing to offer their shares. So this particular company, it is asking the shareholders that tell me the price at which you are willing to offer your shares to me. So there are these promoters which are inside the company, and they want their shares back. They want back the shares of the company, and the company is telling those people, those persons who are having the shares, that okay, tell me the price at which you will give me this money. And the process which is used to follow to discover this price, it is termed as reverse book building. And this is the process which is being used by the companies to discover the price at which this company is going to buy all the securities which are there in the market. And now, since there is no security left in the market after doing this particular process, the company can go for delisting. Delisting means permanent removal of securities of a listed company from a stock exchange. So now there is no share in the market, the company, it goes for delisting. Now how the current and proposed system they compare. Now currently, if the price discovered through reverse book building is not attractive to the promoter, so the promoters are not getting much money for the shares through this reverse book building process, then they may unilaterally reject the price and the whole exercise becomes futile. So the promoters may say, okay, we don't agree with this price, so the whole exercise that ends and the delisting is cancelled. Now the SEBI has proposed that the promoter may be allowed to make a counter offer to the shareholders. So if the price through reverse book building process is say ₹50 per share, and promoters feel that this price is way too low, so they can reject that particular price, and they can say that okay, we are coming up with counter offer, that if you are willing to offer these shares for ₹40, we are willing to buy those shares from you. So if this counter offer, it is lucrative to the shareholders, and if they accept this counter offer, delisting can be done, and delisting should be treated as successful. So this is how the change is being made. Earlier, if the price through reverse book building failed, the delisting failed, but now an additional option is there in the form of counter offer from promoters. So this is the change which is being proposed. Now let's move to the next one. SEBI may consider special audit of MCX technology. So SEBI has conveyed that it is displeased with the performance of multi-commodity exchange, especially on the technology front, because there have been recurring technical glitches on this particular platform. And over the last year, there have been around 6 major technical glitches, and 5 of them have been in the just past few months. So this points out that there is something which is wrong with the technology of this particular exchange. And if we try to understand that how the technology it is being employed in this particular exchange, then for the technology there is this agreement which this company has with another company which is 63 Moons, and this technology agreement, it is valid till October 2022. Now this deal can be revoked only if SEBI rules that MCX technology is not up to the mark. So if the SEBI would rule that MCX technology is not up to the mark, this contract is going to be terminated. So SEBI is presently displeased. It is worried that if these kinds of technical glitches they continue to happen in this stock or commodity exchange, it is going to hamper the interest of the investors as well as brokers. Now if we try to understand the meaning of this term, which is special audit. Now this special audit is a limited scope examination, and this has been designed to examine the allegations of fraud, theft or misappropriation of funds. So in special audit, there is an auditor which is appointed, and this particular person has a very limited scope, but the depth is very wide. It has to examine just one scope, that is whether the technology is proper in MCX, and it will go in depth to examine this particular scope. Now these audits, they are needed when it is suspected that laws or regulations, they are being violated in the management of an organization. Next, let's move to Snapchat. Okay, so we are now moving towards a social networking thing, which is Snapchat, and how this Snapchat is linked to SEBI. Now it would amuse you that SEBI is now thinking to follow Snapchat. Now how it is going to do so? SEBI is going to be follower of Snapchat. This is going to be in the method by which the Snapchat it came up with a public issue. So SEBI is contemplating implementing a Snapchat model for listing of Indian startups. So what is this Snapchat model? Snapchat in last year had come up with an IPO in which the shares were offered without any voting rights. So if you remember, we learned that equity holders, they are the persons who get the shares and they get the voting rights. Now how can this be if the shares they are coming up with without the voting rights? So these are some special categories of shares, and these were issued by Snapchat to get money, but at the same time to do not get disturbed by the interference in management of the new shareholders who are putting in their money. Also, the company decided that it would not provide investors with the revenue forecast, as this would keep the regulatory burden low and it would ensure no hindrance in the business in the startup phase. So this move has caught the attention of SEBI also, and SEBI is thinking, why not allow this for the Indian startups? Why not we promote the Indian startups to get money from the initial public offering or IPO, and at the same time they have to comply with the lesser requirements because the shares which are being issued, they are without any voting rights. Now what do we call these shares? If you talk in technical terms, they are shares with differential voting rights, or DVRs. Now these are those shares which are similar to ordinary equity shares in all other aspects, but they have lesser or no voting rights. So if you talk about the normal equity shares, they are the shares which are held by the persons who are the real owners of the company, and they are having voting rights and they vote at the general meeting of the company. But if we talk about the shares with the differential rights, and then these are going to be those shares which are having differential rights as to dividend, voting, or with regard to any other matter as may be prescribed. So they will be having a differential treatment and they are not going to get voting rights in the Snapchat case. Now in India, in the Companies Act also, there are some similar provisions for differential voting rights. So that's why it is being thought of using this particular model for Indian startups. Now let's move forward. Recent SEBI recategorization of mutual funds. So again, SEBI is trying to regulate the mutual fund industry, and in this respect, SEBI has come out with its guidelines with regard to recategorization of mutual funds. And these guidelines, they were necessary because there were a huge number of mutual funds which were coming in the market, and they were offering a huge number of schemes which were just confusing the investors. So now it was necessary that all these schemes, they should be streamlined, and there should be some very simple schemes which the investor is able to comprehend very easily in the market, so that the mutual funds they do not play with the investors. They are there to help the investors and protect the interest of the investors. So these are the mutual funds, and I believe you must all be aware by now about the concept of mutual funds. Now if you try to look at the different types of mutual funds which are there, there is a debt fund or fixed income fund. Now this particular fund, it is putting its money in those securities which are generating fixed income. For example, corporate bonds, debentures, government securities, and other money market instruments. And on the other side is the equity fund or the growth funds. They are those funds which are putting their money in the equity shares of companies. And if we try to balance these funds, the funds which are investing in both equity and debt, they are called as balanced funds. At the same time, there are some other categories of funds, like there is a liquid fund which is putting in its money only in those particular areas in which there is very high liquidity. And then there is also tax saving funds through which people can invest their money and they can get concessions in income tax returns. Now if we'll try to look at the key points regarding recategorization of mutual fund. Now the fund house can offer 10 types of equity funds, 16 categories of bond schemes, and 6 categories of hybrid fund schemes. So SEBI has put a bar, okay, you can only issue this much of equity funds schemes. You cannot go beyond that, because if there are going to be so many schemes, they are simply going to confuse the investor. Further, the new category, it clearly defines the tenure or the type of security. For example, a short duration fund can invest in a scheme with a maturity of 1 to 3 years only. And with this precision and definition, the fund managers, they are now having less flexibility in managing a scheme, because now they will have to comply with these norms that the duration, it cannot exceed 3 years. Now a corporate bond fund, it can invest in securities in a manner that at least 80% of the fund is in corporate bonds rated AA, and a credit risk fund must have at least 65% invested in corporate bonds of credit rating of AA and below. So this is the new recategorization of mutual funds which is being done by SEBI, and these are the main points with regard to this recategorization. Now let's move forward. Finance Ministry to transfer shares of some PSUs to SNIF. So if you remember, we discussed that public sector undertakings, they are mandated to achieve 25% public float, public shareholding, and these public sector units undertakings, they have to comply with this requirement in a time bound manner. And with this particular objective in mind, to comply with these norms, Finance Ministry is planning to transfer the government shares of 10 public sector undertakings like MMTC, Hindustan Copper, etc. to meet these SEBI's minimum public shareholding norms. So this transfer is going to be proposed to be made to Special National Investment Fund, or SNIF. Now, is this fund new? Is this fund going to be specially established for this particular purpose? The answer is no. This particular fund is not new, and it was set up way back in 2013, and this was set up to transfer the shares of 6 SIC companies, and the SEBI had required that center should transfer the shares of these 6 companies to a separate fund, and this was a Special National Investment Fund which was to be managed by independent professional fund managers, and they were to sell the shares within a period of 5 years. And whatever money was to be realized from this particular sale, it was to be used for social sector schemes of the government. So this is not new. This is Special National Investment Fund. It was set up in 2013, and now the government is proposing to use this fund again in order to meet the 25% public shareholding criteria put in by SEBI. Let's move forward. SEBI plans to cap mutual fund commissions to curb mis-selling. So SEBI is planning that the distributor commissions which are being charged by mutual funds, they should be capped. There should be a restriction on how much commission the mutual funds they can charge. And SEBI is planning to cap lifetime distributor commissions for fixed income schemes at 1.5 to 2%, and for equity oriented mutual fund schemes at 4 to 5%. Now the main thing to remember is that there is going to be a cap on the mutual fund commissions, and this is going to be done in order to curb mis-selling by the mutual funds. Now how do this mutual fund commission is related to mis-selling? Now what happened was, many distributors, they used to move their customers frequently from one scheme to another, and as the customer was moving from one scheme to another on the advice of mutual funds, the mutual funds, it used to charge commission from that particular person, and this resulted in a high amount of commission flowing to the mutual fund distributors, and they kept little regard for the ability of the person to handle the risk. They were just moving the person from one scheme to another in order to get their commission. So as a result, they were selling those schemes which were earning them high commissions. So under the existing SEBI norms, the total expense ratio of an equity scheme, including commission brokerage, is kept at 2.5% on 100 crore asset scheme, 2.25% on next 300 crore assets, and 2% on the next 300 crores. And beyond 700 crore, AMCs can only charge a total expense ratio of 1.75%. So SEBI is thinking of working in this particular direction in order to cap the total expense ratio of mutual funds. Now beyond these also, asset management companies, they used to incentivize their distributors by paying them from their own wallets. Now the new rules, they will put a maximum cap on commissions, and this is going to be an attempt to curb mis-selling. So when there is going to be a cap on this commission, it means that the distributors, they cannot earn more than that, and that's why they are going to have less incentive to move the customer from one scheme to another. Now let's take a look at some of the MCQs which can be framed out of this topic. So the first question is, Dash is a professional individual who executes buy and sell orders on behalf of clients for stocks and other securities in a listed market or over the counter, usually for a fee or commission. Options are stockbrokers, underwriter, merchant banker, or depository. So this we have understood that this is a stockbroker. Next is, Dash is when a private company or a corporation raises investment capital by offering its stock to the public for the first time. So we learned this also, that when a company is coming up with this offer for the first time, this means that company is coming up with an IPO or an initial public offer. So answer is going to be option number B. Next question, reverse book building is a process by which? So we have understood that this is the process by which the shareholders, they are asked to bid for the price at which they are willing to offer their shares. So this is the option number A here. So answer is going to be option number A. Next question, which of the following is correct with regard to Special National Investment Fund? Options are, it was approved by government in 2013. It was formed to transfer the number of shares that was required to make 6 SIG companies compliant with the minimum public shareholding norm, both A and B, or none of the above. So friends, again we have discussed this, that this particular fund is not new and it was set up way back in 2013, and it was set up to transfer the shares of the SIG PSUs. So the answer to this is going to be option number C, both A and B. So friends, these are the answers. So friends, this was all about our discussion on the SEBI current affairs for the month of July 2018. Thank you.